You finished your last day at work, you have $1 million in your 401k, you're ready to retire. You're probably thinking about rolling your 401k into an IRA, but you're worried about some of the taxes and penalties that you heard can happen during this process. So today we're going to discuss how to avoid these mistakes in a 401k rollover and make sure that your money keeps growing tax deferred and avoiding any IRS penalties. Before we get started, my name is Andrew Matz. I'm a financial planner at Oak Road Wealth Management, and we specialize in helping pre-retirees and retirees with $1 million or more retire confidently. Today we're going to keep things really simple. That's why I'm here at this whiteboard. So to get started, what is a rollover? It's really simple. All you're doing is moving from a like account, 401k, to another like account, which is the IRA. The IRS does not see this as a distribution. There's no fees, there's no taxes, no penalties, but I should clarify that I'm specifically discussing a direct rollover here. When this happens, you're just moving the 401k to a new home, the IRA. That's it. Doing this, you avoid any potential penalties and taxes that can come with an indirect rollover, which we're going to talk about here in a second as well. So why would you even consider rolling into an IRA? What's the big advantage of doing this? With 401ks, they're really great vehicles when you're accumulating your wealth. You have an employer match, you have your money automatically getting pulled out of your paycheck, and that money is being automatically invested depending on the investment option that you chose. On top of that, there's really good creditor protection. But the breakdown here happens when you're ready to take that money out. Some plans restrict you on taking periodic distributions, meaning that you would have to take a full distribution of the entire account if you wanted your money out. This is where IRAs are really, really helpful. A lot of times with our clients, we say that an IRA is going to create their retirement paycheck for them. Automatically, at the beginning of the month, they're going to be sent their money straight to their bank account. It's really smooth and really simple, and one of the reasons that we like IRAs for retirees. So you're ready to do the process. You know that an IRA is what you want. How do we actually do this? We do it in a really simple 4-step process. Your first step is going to be opening the new account at the financial institution that you choose. For example, this might be at Charles Schwab. You might open your new IRA. This is where the 401k is getting rolled into, your new home here. Step number 2 is going to be contact your old 401k provider. You should be able to find this information on one of your recent 401k statements. It'll tell you the financial institution your 401k is at, and hopefully a contact phone number as well. This is important because you do want to call that phone number. A lot of times with our clients, we're on that phone call as well. So we're calling with them to their old 401k provider to make sure that we do step number 3 correctly. And step number 3 is to request the transfer, but more importantly, requesting a direct rollover. And you do want to say those words. And so when you're on your phone, you do want to say specifically, I want to take a direct rollover from my 401k. And when they hear this, they're going to understand that the check is going to be made payable to, in this example, Charles Schwab. So instead of being the check payable to Andrew Matz, for example, it'll be made payable to Charles Schwab for the benefit of Andrew Matz. That's how you want it. That's how you avoid any accidents, any mistakes, by making sure that that check is not made out to you, it's made out to the financial institution. And step number 4, this is also really important, invest. When that check hits your new IRA, it's not automatically going to get invested. You have to actually go and invest that cash yourself. Unless you have an advisor helping you, then they can help you handle that process as well. So you probably have heard that I've said direct rollover a lot of times, and this is because an indirect rollover is a possible way to do a rollover as well. So with an indirect rollover, that check would actually be made out in your name. So for me, the check would be payable to Andrew Matz. And in that case, unfortunately, the 401k provider, they are legally required to withhold 20% of the balance for taxes. So if you have $1 million 401k, the check's actually only going to be for 800,000, and the other 200,000, that's withheld for taxes. They have to do it. So now you have 60 days to deposit that check to your new IRA, and you have to deposit the full $1 million. That means you have to find $200,000 somewhere to deposit in that account. Granted, eventually you will get that other 200 grand back that they withheld, but not until you file your taxes. So this can be a liquidity issue, and a lot of times lead to mistakes, lead to penalties, lead to taxes. That's why we just try to avoid it altogether, and we request a direct rollover. So now that the hard part's done, let's talk about some more advanced tax strategies that you might consider both before and after doing the rollover. So first, let's talk about NUA, which stands for Net Unrealized Appreciation. When this comes into play is when you have company stock in your 401k. If this is the case, you may want to consider moving that company stock into a brokerage account instead of rolling it into the IRA. Because if you roll it in the brokerage account, or if you move it into the brokerage account, it could qualify for long-term capital gains treatment instead of having to pay, ordinary income tax when you eventually take it out of your IRA. And a quick note, you want to consider this before a rollover, because if you do go ahead and roll it all into the IRA, you can't go back, you can't move it to the brokerage account now. You have to pay ordinary income tax whenever you withdraw now. There's no way out of it. This is probably something I'll make a more in-depth video about in the future to help on this subject. Another really important topic is Roth conversions. We have a lot of clients who fall into a category of, they have $1-2 million in a retirement account in their IRA. It's all pre-tax, and when they retire, they might be delaying their Social Security benefits, and they find themselves in a lower tax bracket than usual. So they were working, they had a higher tax bracket, all of a sudden they stop working, they haven't taken Social Security yet, they're a fairly frugal person, not having to withdraw a lot out of their IRA, and in the future, their tax bracket is also probably, we expect, going to be higher, because they're going to have Social Security, they're going to have to take RMDs, which is where the government forces you to take money out of your IRA. So they have this period in a lower tax bracket. We encourage people to take advantage of that lower tax bracket and go ahead, move some money from the traditional IRA into a Roth IRA and pay the taxes at that lower tax bracket instead of in the future at a higher tax bracket. This can save a lot of money over your lifetime and over the lifetime of your kids as well, because if your kids later inherit the account, they're going to have to withdraw the entire traditional IRA in 10 years, so they could be pushed into higher tax brackets as well, or they may already be. So these are two kind of important tax planning strategies that we like to walk through with our clients. The main one that we do is Roth conversions, and again, saving lifetime taxes. So we've reached the end, but I'm going to walk through one important question that we get quite often with direct rollovers, and that is, if I get the check in the mail, so the check is mailed to me, is that still a direct rollover? And the answer to that question is yes, it could be, as long as the check is made payable to the financial institution for the benefit of your name. So even if you receive the check personally, but it's not made out to you, it's still a direct rollover. You just need to forward that check. But you're still avoiding a lot of the issues of the indirect rollover. So we've reached the end. If you'd like this video, please give it a like, subscribe for more content in the future. And if you're really stressed about retirement, you saw the clear path for a direct rollover, but maybe you still would want some help or investing those dollars, or understanding how it can be an income stream for you in the future, please click the link in our description and schedule an introductory call with us and see if we could be a good fit. But please keep looking out for future videos. Thank you.